Hey everybody.
Sean and Kelly here, Price and Price Group of Sampson Properties, and what are we diving into today?
The 50-year mortgage.
Ooh, it's gonna be fun. I'm excited about this one.
Me too.
All right, here we go.
First, let's start off by answering last week's pop quiz.
Yes.
The question was, in the Northern Virginia area, home prices, the median home prices in 2019 were roughly how many times more than the median income?
Yes.
Right?
Yep.
And the answers were A, 2.5%,
Nope,
B,
not 2.5 times.
2.5 times, thank you.
Yep.
B, 3.5 times, or C, 4.5 times.
Yep. And we discovered that the answer was C, 4.5 times.
Yes.
2023 or 24, I can't remember what year we had.
24, I think.
That ratio actually went down, but
Because-
affordability did not.
Yes.
Yes. So that
Affordability was worse because of interest rates
Yep.
and everything else. Go back and watch that last week where we
totally
explained
dive.
that.
Yeah, absolutely. All right, so we're talking about the 50-year mortgage. What is it?
I will put on my lender hat
Yes.
and say, first of all, this is just proposed. It's not actually here yet.
Okay.
But a 50-year mortgage is just where they're spreading the loan term out over 6 months or 600 months or 50 years instead of the typical 30-year fixed, and they're a 15-year fixed.
Yep.
So that's what it is.
Yep. Okay. And it's just concept now. They're
Yes,
proposing
they'd have to change a whole lot of things because this does not follow the ATR QM. The ability to repay is a rule, a guideline that's put in place for qualified mortgages. Right now, this would break that rule. So, and we're going to go into some reasons why.
Okay.
So a lot would have to happen to make this a thing.
Okay. Well, I have a question for you.
Yeah.
Next, we want to go into why they're doing it. But
Yeah.
do you think that the timing of this has to do with the recent elections and the affordability issue being brought up in all those elections and realizing that that's really important to Americans?
Yes, but I do think it's as a talking point. I don't think that anyone with an actual ability to, or incentive, interest in thinking through the process would see this as more than a Band-Aid.
Okay, so I was looking at her like this because we actually did our own research. We have not talked about this, and I thought she was going to say something that I was going to totally agree with, and we were going to go into battle. But okay. So
you ready.
I'm with you on that. I'm with you on that. Okay. So you think that the reason for this is to address the affordability issue, but if you think
Yes.
through, if you actually look at the long term, is it going to address it, or is it more of, like you said, a Band-Aid?
Yeah, and I found a lot of economists, they completely disagreed with this being a good idea, which I was like, oh, thank you. And I want to talk about Japan later.
Okay.
Do you know why?
No, I'm excited to hear about it. But
So it didn't
I
cross
have
your
points.
research
I
path.
have points that could be that it could be a good thing for certain situations. So we'll have to dive
For
into
certain people.
it. And situations. We'll dive into it. This would be fun. Oh, it's gonna be so much fun. Okay. So I want to give an example
Yes.
of what this looks like. So I ran some numbers on a $730 home.
Oh, good. I did mine on 400.
Okay.
But you get the math.
All right,
I'm
so
sure that
so
got-
700 because we're in Northern Virginia, so it's a little bit closer, right?
You're right.
So $730,000. Each loan had 20% down. Each loan had a $584,000 mortgage.
Yep.
And each loan was at 6.3%, which is around where we are right now.
Okay.
Now, keep in mind that a 50-year mortgage is probably going to have a higher interest rate, just like a 30-year has a higher interest rate than a 15.
This
but
is true.
We're just going to look at it even across the board. So
So you did keep the interest
I
rates
kept the
same.
interest rates the same, yeah. So
I wouldn't have done that.
we want to compare apples to apples, so.
But that's not. It's not an apple.
Okay.
15 year is not an apple. If a 30 year is an apple, 15 years a banana. I was gonna go down fruit.
Anyway, so let me give you what I got. And if you got
And
something
then I'll
different,
give
you can
mine
throw yours.
because
Yeah.
it's 7%
So if you
Because
look
it
at,
wouldn't be the same
because you're going to guess at the interest rate. So
Okay, do
the
it.
difference would be a 30-year mortgage. The payment would be $3,614.80 a month. Now that's principal and interest only.
So 3,600.
$3,600.
Okay.
The 50-year would be $3,204. Okay, so it's a
Okay.
difference of $410 a month. Okay, which is a significant chunk.
significant.
Yeah, it's a 12.8% reduction in payment. Okay,
Okay.
so that's the payment. The total payout for 30 years, 1.3 million and some change. For 50 years, 1.9 million and some change. So it's a difference of 600,000, or an increase in 47.8% in the total payout. So you're getting a 12% monthly reduction, but if you keep the mortgage the whole time, you're increasing your
But
total
who
payments.
keeps their mortgage that long?
That's where the
I'm going
conversation.
to tell you who later, but it just doesn't really happen like that.
So that's an example of what this looks like in my estimation. Tell me about yours with the interest rate difference.
Okay, well, mine was a 400,
Okay.
right? Down payment, I did 10% because
Okay.
I was thinking if we're talking affordability, we're talking about first-time home buyers.
Sure.
So I appreciate that
Sure.
the pricing that you did, but those are people who probably have bought at least once, right? So for starter home, $400,000, 10% down, so the loan's $360,000.
Yeah.
I did do different interest rates, so I
Okay.
just said about 6% or 6.5% for the 30-year.
Okay.
And then I took it up to 7%, which I think is a lot more realistic
Sure.
for the 50-year.
Okay.
Okay, so at the 30-year at 6.5%, we were at $22.75 a month.
Okay.
P&I total amount paid over 30 years was $819,000.
Okay. Makes sense.
The 50-year, the payment was $21.65. Okay, so that's only $110 a month.
Mhm.
And then the total paid over 50 years instead of $819,000 was
Mhm.
$1.3 million.
Yeah, yeah.
So I do think that this is probably a more realistic scenario for the people we should be talking to.
Mm-hmm.
We should be talking to first-time home buyers who need to get into a house to start, you know?
Yep.
And I don't think that's who we're going to end up talking to, and that's why I really hate the 50-year mortgage.
So that's an interesting idea there, because when I compared the equal interest rate and a $400 a month payment, that's significant for people.
Right.
A $100 a month payment for that much of an extra payout
Right.
is not a significant amount. So it's not going to entice people to actually use it. So is it even just more of a window dressing?
That's what
Yeah.
so that's my big thing about this is if it's the affordability, we're talking about people who maybe have to try like a one car household,
Right.
right?
They're
Struggling with childcare payments and all of this. So
I hate paying for
$110
my kids.
is not that big a deal when you're thinking about these really high dollar
Right.
things. Who it does help is
Mhm.
people who don't need as much help, and investors. That's
Mhm.
what I'm telling you guys. I think that it's going to bump the home prices up, just like the big boo of an idea with the low interest rates
Mhm.
during the pandemic, because while there are some who really needed that to get into a house, and there are many of us who got into
Yeah.
houses, a lot of us didn't need to,
Right.
right?
Right.
But they're talking about the portable loan thing
Yeah.
too. We need to talk
Yeah.
about that
We'll
next
talk about
week.
that next week. Yeah.
But then investors, if they're allowed to get in this, I think that's a bad idea,
Yeah.
because they've got all the money to throw at all these houses. They're going to go blanket the area. This supports home sellers,
Mm-hmm.
like people who currently have their houses, because they're going to start jacking the prices up again.
Mm-hmm.
And the people who really need this are going to get outbid, and it's going to be worthless. And then there's the whole retirement crisis. I'm getting into my cons.
Yeah. Okay. So
Let
I
me
agree
stop.
with you
Let
on
me
all
stop
that.
because I'm heated on
Yeah.
this topic.
Yeah, I'm with you on all those things. I do
Yes.
have a little bit of pushback on the investor thing, but I'm with you in the theory of it, that it would be enticing to investors. But if you take an investor position, they pay extra money. They pay a higher percent interest rate. So if that little $100 difference, they're probably going to pay an interest rate that would not make it feasible to go 50 versus 30.
But they're going to do it because they're just going to rehab it and flip it within a few months
If that's a possibility,
at
you're
a
not wrong.
much like a
Yeah.
boop, boop, higher
Yeah.
price.
Yeah.
So if there are overlays that say this is only for first-time home buyers,
Mhm.
it's only in maybe certain areas or certain
Non-investor loans.
like
or
there are
something.
ways to
Yeah.
make it work, but I don't think we're far enough along for them to be thinking about
Yeah.
it right now.
Okay, so let's talk about, let's dive into a couple pros. I think we both have the same position on this, but let's dive into a couple pros to start.
I
what
have one.
You have one? I got 5, because that's, I am
Mr.
apples to
Optimistic.
apples. Okay, all right, go. What's
Okay.
yours?
Slightly lower monthly payments.
Ding ding, got the same one. Okay. Number 2.
Oh wait, I do have two. Go,
Okay.
you go too.
Okay, my first number 2 was improved cash flow flexibility, potentially, but it's like
For whom?
well, the lower payment does improve cash flow even for a first-time home buyer, but that's also for investors. So that's That's the negative, but I agree.
I
That's
know
one of
that's
the pros.
where your mind is.
Yeah.
And,
Okay.
and trust me, if they made these and let investors do it, we would be all
Right.
day, right?
Right.
Okay, earlier access to home, where then you could refinance.
Yes.
Because as long as you refinance for better terms, like better as far as ability to repay, if it's a benefit to the home buyer, then you can refinance as early as 6 months after.
Yep.
So if you just kind of need a bridge to get in for a little bit, then I think it can be a good thing.
And I had better access to home ownership as well, and I'm with you on that because it allows someone who couldn't otherwise afford to get into home ownership to come in and to be able to take advantage of potential appreciation.
Yes.
And that appreciation could put them into the position of being able to refinance with that lower rate.
True.
And into a better, but it depends on how it all plays out.
This is
too.
true.
Yeah.
Yes. Okay.
Number 4, strategic for investors. We both agree on that feeling.
But yes.
Okay. And then
But when we go to the why,
it doesn't solve the why.
Right. It's they're snowing people on. We want to really help Miss First Time Home Buyer, Mr.
Yeah.
First Time Home Buyer, and it's like, hey, investors, we got you.
That's
you know?
that's a huge. So we get to the cons. That's a huge thing because this is not going to what you said about it being a Band-Aid. This will not fix the affordability crisis at all. It'll be a short-term.
Neither
Band-Aid.
is the fucking $25 an hour minimum wage proposed in Maryland. Okay.
I know. Risky alternatives, that's the other benefit. And I do agree with this one. It keeps people from using potentially like 2-year ARMs or things like that to get into something that they may not be able to afford if the rates go up on that. So it gives them a lock in at a certain rate.
I cannot argue with you on that.
Yeah, so that's that. Okay, so cons. This could be a long one.
Okay.
Go for your first one.
Huge increase in total interest paid.
Huge.
That's
and interest
huge.
rate.
But who is going to? I'm going to get on a super tirade about one of my cons. But who's really going to keep it? So this is a con where I'm like, yeah, if you're going to be in your house forever, then it's a really bad idea. But I'm like, but who's going to do it? So for me, this was kind of a minimal, minuscule con.
I'm getting this mortgage at 70. That's what I'm getting this mortgage. Okay.
Yeah, but that's smart.
Yeah. So total interest
And
cost.
do the one where it's like if you die, it's automatically paid off.
Yeah, that one. Yeah, I'm
That's a
in.
good one.
85. Now I changed my mind. Buy several houses.
Yeah, I'm younger than you.
Yeah. So the next one, my next con is a slower equity buildup because, as you know, in the beginning, when you're making your monthly payment, I'm talking to you, and you don't know this.
No, I do know
I know
this.
you do, like 100%.
Yeah.
Your beginning of your mortgage, you're paying like
Yeah.
90% of the payment goes to interest, and
Yeah.
that's going to go for a longer time because now you got a 50-year mortgage. So it's going to take a long time to build up equity,
Yeah.
and that's a negative for investors that hopefully will keep them out of the game because they're not going to have that debt pay down so quickly.
But they're just going to resell. It's not good for a buy and hold, but it's going to be
Right.
good for a flip.
If they can
right?
use it for a flip, yeah, that's true.
It's almost like the amount of equity that you're paying, because like you said, it's at the beginning. It's almost like you're renting your house anyway. You know, one of the big things to home ownership is that equity build. I always say, you treat your house like a savings account.
Yes.
Right? And with this kind of situation, your house will not be a savings account.
That's right.
Okay.
You go to the next one?
I said, again, it pushes home pricers up. I
Yeah.
said investors
Yeah.
who it doesn't need to help.
Right.
We don't need to help investors.
Yeah. I don't think that flippers will necessarily use this unless they're the type of flipper, because if you have a minimum of 6 months to be able to pay it off, all right, a minimum,
Yes.
that's too much holding cost for a flip investor. Unless that flip investor is somebody who wants to hold it for at least a year to reduce the capital gains. But most flip investors, they're looking to turn within 3 to 4 months. So I don't think they're the problem. I think it's going to be more so the buy and hold investors, and if the numbers make sense for them. So that could be easily gotten rid of with a higher interest rate on investment properties.
Yeah, because it's almost like they're renting at home buying rates.
Yeah.
For a longer time. So they just have someone in place paying their rent for them.
Yep.
They're happy.
Yeah.
Okay, I see.
Yep.
I see.
But I got one, and you probably had this as well. A lot of people, the financial dream of home ownership is, as you age, if you do pay that house off, now that's your wealth. And if you take that and now it's going to take you another 20 years to get to that point, that's the retirement plan for the majority of Americans. And I don't think that that's going to help the world at
You
all.
hit the heart of my issue with this. You are creating a debt for life,
That's right. That's right. The bank is going to own this house forever.
And this took me down a whole other rabbit hole of the current retirement crisis,
Yeah.
you know, and
Mhm.
and I learned a lot about that too. And that's going to be a huge problem that I don't think this is a good answer.
Do you remember Uncle Paul?
Oh, yes.
So when we were in chiropractic school, just long story short,
And
is
by
I
the
could
way, he
make
always
it.
says we.
Yeah, when I
I
was in
didn't go to chiropractic school.
but she
I
was
was
with
just his
me.
trusty
She
sidekick
suffered.
raising the baby.
You suffered through that with me so hard. There was a practice consultant that came in, and he basically would finance students to open up their practice,
Yeah.
and he would take a cut of the percentage, and you'd pay it off in over 10, 15 years, something like that. There was a conversation that he had with a friend of mine, and he told that friend, he said, the key to making this program work is to get it to where the student never pays off the practice, because you want to have that cash flow forever. That's what this is. It is a chance for the bank to keep that house and that cash flow forever. Unless you're a savvy buyer and you refinance out, you're basically just paying the bank. An extra $600,000 in my example, that's even with the same interest rate. It's ridiculous, 47.8% or whatever more money. So anyway.
Yeah.
All right.
Yes. Well,
Good.
since we're in agreement,
Yep.
I'm going to ignore all of my points about the retirement crisis. I thought I was going to have to convince you, but
Oh,
it
no,
sounds
I
like
agree.
you're already convinced.
I agree, yeah.
But can we talk about Japan? When
Yes.
can we talk about Japan?
As soon as I say this last thing.
Okay, good.
Okay, and I think we've already addressed it, but the whole purpose of this, I want to address your Band-Aid statement, because I think it's absolutely factual and it needs to be understood. The whole purpose of the affordability issue, there are three factors. Number one is income, number two is interest rate, number three is supply. We're not addressing the supply. In fact, we're actually going to, in the short term, until everything catches back up, make the supply even more difficult to get, because the buyer demand is going to overweigh the supply.
Just like in the pandemic.
Just like in the pandemic.
Yes.
So it's not addressing the supply factor. I saw a study yesterday, they were talking about why are builders not building newer first-time homes.
Okay.
And this was just a tangent, I'll be really quick, but one of the things they said was, number one, it's very difficult for builders to do that because of cost of materials. It's hard to build a $200,000 to $300,000 single-family home now. But number two, the current homeowners that own $500,000, $600,000, $700,000 houses don't want a $200,000 neighborhood going in next to them, because that's going to bring their property values down. So there's actually a resistance, and they had some title for it, but there's a resistance to current homeowners to new home building, our first-time home buyer builders happening. So there's a lot of resistance against that, and this is not going to fix it. It's going to have to be more townhouses, more condensed living dwelling units, things like that.
Can't we all just get along?
We can, but we always want to protect that equity. So
I mean, you can.
yeah,
I
mean, it's
have a
tough.
whole thought about this too.
Yeah.
You can protect it. I mean, that's the whole reason we have different neighborhoods, right?
Yep.
You know, and they can all be symbiotic. Is a stupid word to use in
No,
this.
I think it's good, cohesive, symbiotic.
They can all be cohesive
Yeah.
and mesh well and be different.
Yeah. Somebody needs to hire us to solve all this.
I've got this.
Okay, tell me about Japan. I am very interested
Okay,
in this.
this came up nowhere for you.
No.
I'm saying, and I'm sure there are so many people out there. You guys are brilliant in this area, especially like way smarter than me. So please correct me.
Yeah. Any corrections to anything that we say? We are not.
We're not what we need to be to
to talk
advise
about
on
those.
any of this.
So put the comments in there, and we'll pay attention.
Okay, so we're Japan. Have you
Yes.
heard of the Lost Decade?
I have not. I've heard of the Lost Decade in several
Okay.
different scenarios, but not Japan.
Okay, well, while the UK is toying with the idea of a 50-year right now, and it's going to be generational, Canada and Australia, I think, have both piloted this, but
Okay.
Japan actually did it
Okay.
when they were having a bubble of the 80s or something like that.
Okay.
They did a whole 50-year mortgage,
Okay.
and their interest rate was even less than 1%.
Wow.
From what I found, it was less than 1%.
Bad idea.
And all of that contributed to the Lost Decade, which was like their big crash in
With
the
their
early
economy.
90s.
Yeah.
Yes.
Okay.
Yes.
Okay. So we have a case study that shows that it does not
yes.
save things.
So
Yeah.
I think it is just a way for
Kicking the can down the road.
and people to look like we care and we're looking for answers.
Yeah.
Which is great.
Yeah.
Everybody, I mean, I do that to the kids all the time.
Yeah.
Like, oh, you don't want
Well, in the 30-year
fish
mortgage.
for dinner? I'm gonna try to find you something else, and then they didn't have it at the
Yeah.
store. You know?
And a good example of this is a 30-year mortgage. It didn't always exist. it came on as a solution. So now we're here trying to address, okay, we haven't solved the problem,
Is
so
that
now,
right?
yeah. Yeah, I don't know any details of that. Like, I
love
do
your
not
brain.
question me. Hey, what do you mean
Where
by
did
general?
you find that?
Oh my God,
Where'd you find that information?
It's somewhere. Maybe I just made it up, but I got a question for you.
Yeah.
You say generational. Does that mean if they take out a 50-year mortgage that if you pass away, it stays in the family? Like it sticks?
I think there had to have been some, because that's
a
the word I
really
kept seeing
bad
and
idea.
seeing that it had to pass down.
Oh my gosh, if we had to take on our parents' mortgage or something, that would be horrible. It could be, but yeah, I don't know.
All right, let's have
Okay.
some deep thoughts for it
Okay.
to wrap it up.
Okay, so my opinion is, if used strategically, I just think it's a bad idea. Especially if it's only $100 difference at the
Yeah.
price point. I don't think that it's going to actually get people into homes that they couldn't get into otherwise.
Yeah,
And I just don't see how it works. That's my opinion.
I agree with you. I think that a very few number of people would actually be well served
Yeah.
to just get them in the door, refinance.
Mhm.
But I just want to leave you guys with looking at what happened with car prices. You know,
Yeah.
when they went from 60 to 72, and now I think they're floating like an 84 month
Yeah,
loan.
that's exactly
And
right.
when they started doing that,
Car prices.
went up. Now I know we can say
COVID.
and import
Yeah.
tariffs and all this kind of stuff, but still.
Yeah.
But still.
Yeah, I don't. It's not going to be a solution. That's almost
Yeah.
100% certain, and I don't think it's going to help that many people.
It's a no.
It's a no. Okay. All right. All right. So that's it for today. Next week we will talk about the portable mortgage. I'm excited about that one. I really like this
That
idea.
one I have stars. Wait,
Yeah.
these are hearts. I have hearts in my eyes
Yeah.
over the portable mortgage.
But we haven't researched yet, so we
we have
may
not.
miss out. Okay. All right, guys. If y'all have any questions or comments, please let us know.
Oh.
If you would like to have a we need the quiz. Yes.
I have a quiz in here somewhere.
Okay, while you're looking for that quiz, if you want to reach out to us, if you're a buyer or a seller, if you have any questions about the current market,
I have a really great quiz.
give us a call at 703-783-2143. And did you find the quiz?
I have the pop quiz.
Yes, go.
This week's pop quiz is, on a $400,000 home with 10% down, how much more would you pay over the life of a 50-year loan versus a 30-year loan?
Okay, I can't give the answers. A, B,
Yes,
C.
yes.
A, 100,000. B, 600,000. Or C, approximately 500,000.
Or D, 1.3 million.
Is that how much you pay over it?
Yes.
Okay. Yeah,
Wait,
there you go.
over?
Yeah. Anyway, C or D. Oh, I mean, guess.
We'll answer you next week.
That's right. All right, guys. We'll see you guys next week.